biggest story in tech this week is about how Leopold Aschenbrenner, a 25-year-old who built a almost $50 billion hedge fund investing on AI, just lost almost all of it in a matter of days while he was at his wedding. His wedding, which by the way was in Silicon Valley and included breakout sessions for ideation. And his wife is actually the chief of staff to Darren Amodei, who's the head of Anthropic. So this is like a Silicon Valley, like royal wonderkin couple. But now it's all come crashing down, basically, but why? So Leopold Aschenbrenner, he was 15 when he got accepted in Columbia, graduated in 19, valedictorian, regarded as like having a perfect academic record by like the head of the economics department, like a genius fella. That kind of cockiness can like result in some negative aspects, which we'll see later. But like he started this hedge fund called Situational Awareness. That arose out of a paper that he wrote that like dominated Silicon Valley. That was like basically the idea of the paper that he wrote a few years ago after he worked at OpenAI. He ended up getting fired from OpenAI for like disputed reasons. He would say he like raised concerns about the risks. OpenAI would say that he misappropriated confidential information. So like, who do you want to believe? I don't know. But he published this paper after that called Situational Awareness. That later became the name of his hedge fund that rose to be worth like $48 billion. But Situational Awareness was basically a paper that everyone in Silicon Valley was like, wow, this is awesome. This is amazing. This is genius. And it became the mantra of his hedge fund. And it was basically just like, AI is going to explode. The future of investing is data centers and power, because it's going to require so much power, and the chip companies, and all of those stocks are going to go super up, and traditional technology stocks are going to go down as they get replaced by AI. That doesn't seem that like genius. I guess it was a few years ago. I'm like, if someone want to give me $300 million, I could have told them that probably, but like, I don't know. Anyway, that hindsight's 2020. But that idea turned out to be mostly true, and he became like this super popular investor. Like investors will spend their entire life like as a hedge fund, like chasing 10 to 20 to 30% returns. Like those are all amazing returns. He was getting 400% returns. Like you gave him like $1 and he would like quadruple it at least. So like incredible investment. He got like the heads of Stripe, which is a payment processor, to give him hundreds of millions of dollars. But around last summer, a few people started to like question this because he was investing huge in margin. Like Blackstone, which is a big like financial firm, like declined to invest in his fund because they were like one trick pony kind of. Like you're just saying AI is going to be huge. We kind of all know that. And you're investing with margin. Now, what does it mean to invest in margin? It's kind of a lesson that investors seem to forget every 10 or 20 years, and it results in devastating financial implications and calamitous results like we've seen with this guy. But investing on margin is like, you don't have enough money maybe to like bet as big as you want to, and so your broker, the guy who's like selling you the stocks or something, is going to give you some of that money and you have to put up collateral. It's like basically investing with a form of debt. So your returns can exceed dramatically. Like when you take on debt or like you leverage yourself, you're going on margin, you can achieve greater returns because you're using more money than you have, but also that means your losses can be compounded. And so Leopold did two things. He invested in these chip manufacturing companies on margin, and he bet against, like shorted. You might remember like the Big Short, how people invested like against these financial institutions. He invested against like some traditional technology companies like Adobe that they would go down. And he did both things on margin. It didn't end up working. Like various different things happened. The demand for these chips wasn't as high. And like companies like Adobe, their stocks have been going up. They've been like figuring out a way to navigate the AI it changes in our economy successfully. And so when that happens, you then have to put up like more collateral. The way investing on margin works is like you need a certain amount of collateral, like as a percentage, to continue like that investment, or you have to liquidate it, but which means like sell it all off. But you don't want to have to do that when the stock's going down. So then you have to have all this money to put up as collateral. It's called like a margin call, and he couldn't meet his margin calls recently, which means he had to like figure out a way to liquidate huge chunks of their assets. And they actually ended up at his firm having to liquidate almost all of their public assets, meaning like what was invested in the stock market. Now he still has like private stakes in different AI companies, I think in Anthropic. Mind you, his wife is like one of the highest ranking people at Anthropic. It's just like a whole like cesspool of like everyone's linked together. But yeah, that's what happened, and everyone in Silicon Valley is talking about it, but it kind of seems obvious. Like you shouldn't be investing a ton of margin, especially when it's like on this one bet. Like I understand like you want someone who like believes in their ideas, especially if they're investing your money, but like couldn't anyone have seen that coming, that you can't just expect that to happen? Like it does seem like a one trick pony situation. And also investing on margin is so risky, guys. It's so risky.